2024 was the year of the dragon, and it did breathe fire into commodities, particularly precious metals. In 2025, we enter the year of the well, we'll hear all about it from Nitesh as we dive into our commodity outlook. Welcome to the Commodity Exchange, a podcast where we bring you insights from the world of commodities. Whether you are an investor or just want to learn more about the topic, this podcast is for you. I'm Mobeen Tahir, Director of Macroeconomics and Thematic Research at wisdomtree.
And I'm Nitesh Shah, and I'm the head of commodity and macroeconomic research at wisdomtree.
Nitesh, as we dive right into the commodity outlook, I've always admired your ability to come up with interesting titles. Last year, you made references to the Chinese Year of the Dragon and made the connection with commodity markets. This time, you've done something similar. Give us your title, reveal it to us, and explain your thinking behind it.
Thank you very much, Mobeen. And so, finding antivenoms in the year of the snake. So once again, I've followed through with the tradition of using the Chinese Lunar New Year themes for the title. But the year of the snake, and I guess in Western culture, we always think of snakes as a bit of a crafty creature, and potentially, one that comes with bites. And we need to look for antivenoms against those bites. Now, why have I chose to follow that theme? Well, there are a couple of headwinds that are present for commodity markets this year. We started off the year with increasing bond yields, a strong dollar, both of which are not generally been good for commodities in the past. Additionally, we have a new administration in the US, which is pursuing a tariff strategy. And if tariffs increase the price of imports into the US, generally we can assume that the import-export values across the world may become lower than what they used to be. And historically, lower trade volumes haven't been good for commodity prices as well. And the third headwind that we have in commodity markets is a continued slowing down of China. And China is the largest consumer of all commodities. As China's growth slows, that could be hurtful for commodity demand. So there are some of the snake bites that may be present this year. But in our outlook, we look for the so-called antivenoms. What are the commodities that will be able to resist and persevere through some of these headwinds? So finding antivenoms in the year of the snake.
That's a very fascinating metaphor, Nitesh. I'm absolutely terrified of snakes, but I do love the metaphor. I'm curious though, because we talk about these forces that can bite commodity markets, but we've kicked things off in 2025 on a fairly strong footing for commodities. Do you think the impact or the potential impact of some of these headwinds is yet to take hold on commodities? Do you think there's more to come, or are the antivenoms at play?
Yeah, so we've had a good start to the year, and some of that, we could dig into some of these sort of idiosyncratic aspects of that. So, in January, we had quite a cold snap in various parts of the world, the US and in Europe included, and we are in a La Nina weather pattern this year, um, and that makes some places colder and drier than usual. And what that did was increase the demand for various energy sources, natural gas and oil included. So that drove the prices of oil and natural gas up. In particular, the natural gas prices in Europe rose with relatively less storage than what we used to. Um, in addition to that, we've been seeing precious metal prices rally. and that is on the back of elevated geopolitical risks, but also some of the fears around these trade headwinds that that I mentioned earlier, really coming to the fore. Now, additionally, I talked about rising bond yields and appreciating dollar as being some of the headwinds that we could face this year, and we're certainly seeing that in the the final quarter of last year and into January. But in February, we actually saw the dollar depreciate and bond headwinds fall away. So that actually propelled a number of commodities, including precious metals, a little bit further. So, we've had gone through a couple of months where we've actually seen some of the things that have maybe have been outlining for the outlook, not necessarily come to the fore. But, we are recording this podcast on the 3rd of March, 2025. And um, we know that on the 4th of March, if everything goes to plan, according to President Trump's plans, we should get um, Canada and Mexico face tariffs on their imports into the US at 25%. 25%. That's a pretty large number. And the cross-border trade between North America, so between Canada, US, and Mexico, is very large. So that could present quite a dent into trade numbers just later on this week. Now, Canada has a little bit of an exemption on energy, where the tariffs are only 10%, not 25%. But there are a number of other tariffs likely to be implemented as well. On 12th of March, there are going to be tariffs on aluminium and steel. And they are cumulative as well. So all the tariffs that the universal tariffs that Canada and Mexico are facing, that will have, in addition to that, the tariffs on aluminium and steel. So there is a few of the things that are in their outlook will be faced later this month. But once again, we may have that a little bit of a deja vu feel. If we were sitting here, 2nd of February, we would be saying, "Oh, these tariffs are about 25% tariffs are about to come into play." By 3rd of February, President Trump had postponed them and given an extension. So, you never know what will happen in the next 24 hours. But at the moment, it does seem like some sizable tariffs will be coming into play. And then there's a 20% tariff that China will be facing. So 10% is already in play, and another 10% could come on top of that. Once again, those tariffs have historically been something that reduces trade volumes and therefore being negative for commodity markets.
Speaking of China, Nitesh, you mentioned the risk of tariffs and the economic backdrop facing China in general. Now, we know historically, and of course, whenever we talk about commodities, we have to talk about the economic situation in China. We know how significant and consequential the monetary and fiscal policy measures in China can be for commodity markets. We've got, as you said, we're recording this on the 3rd of March. We've got the National People's Congress happening in China. What policy actions are you expecting, and how significant might they be for commodities?
Yeah, so we've gone through several years of high hopes on China, especially after the reopening of the economy after after the shutdowns during COVID, and China has typically disappointed. Now, we believe China has the firepower; it's got enough dry powder there to do stronger stimulus than it's done in the past. But the tariffs that China is facing from the US may be the catalyst for it to bring out some of that dry powder. Um, Now, to be clear, I don't think it's going to bring out the bazooka like it did back in 2008 after the global financial crisis. China pushed very, very hard on the accelerator, but it turned out its ability to do that just wasn't sustainable, and China facing a slower population growth, less urbanization than we saw back in 2008, realizes that it has to be remain relatively constrained. Otherwise, it could make some quite wasteful capital deployments. But this time around, I think China will um, provide some extension of its piecemeal um, stimulus, and its stimulus is likely to be a bit more domestically geared, knowing that it's facing tariffs from the US and potentially tariffs from Europe, and seeking not to antagonize these other countries further and ratchet up more tariffs or trade barriers. China will probably focus on domestic growth. We believe that China will still target around a 5% growth target for this year. And in order to achieve that, we believe it will be um, continuing to um, uh, uh, stimulate through um, uh, you know uh, fiscal policy, and that fiscal policy will be deployed through once again through local government debt. And historically, local governments have been constrained by the amounts that they can borrow. Now, so coming into this year, we believe that uh, the federal government will allow for $4 trillion special local government bond deployment, um, but also provide a 2 trillion yuan special sovereign government bond program, and that will help a lot of the debts become a lot more centralized. And the 2 trillion yuan quota for special sovereign bonds will be roughly double of what we saw last year. In terms of what China will be promoting in terms of spending, is likely to be very energy transition geared. And we already saw that last year. We saw spending on grid infrastructure at record highs. And the grid infrastructure is very important for electrifying the Chinese economy, moving away from um, using hydrocarbons for energy consumption towards more renewable sources of energy. And given how much China is importing oil and natural gas from the rest of the world, and seeing how the US has become energy independent, China is looking towards following a similar path, but also is constrained by its net zero ambitions by the year 2060. And renewables are really the source to solve that. So China is going to be accelerating on energy transition this year, promoting the uses of solar power, wind power, battery usage, but also on the downstream, promoting electric vehicles, um, because they help move away from oil and oil product consumption. So we're expecting some strong stimulus from China, not necessarily a huge amount on the real estate sector, which has been something that's been holding back the economy. But to be clear, China's demand for a lot of base metals has been strong over the last couple of years, despite even though the real estate sector has been in reverse mode. So if China can keep this up, we expect base metal demand to remain quite strong. That may not be that strong for iron ore and steel, which is a lot more real estate focused. For base metals, though, copper, aluminium, zinc, it remains a very positive story.
So, Nitesh, we've spoken a little bit about the snake and all the ways in which the headwinds could bite. Let's dive into some of the anti venoms that you present in your outlook, starting, of course, with gold. it seems like when people, and certainly when our clients ask us about gold, they say maybe gold has been defying logic in the sense that generally in recent months, I know there's been a slight pullback lately with the dollar and treasury yields, but generally um, they've been on the rise, and that should be a headwind for gold. But gold just continues to rise despite those headwinds. Do you think it's been defying logic, or does it all make sense to you?
Yeah, I mean, gold has done exceptionally well, and you're right. Dollar appreciation and rising bond yields should have been a headwind, yet gold defied them. And we believe some of the reasons gold has defied these forces is that one, sentiment towards a metal is extremely strong. One of the ways in which we traditionally measure sentiment is positioning in gold futures markets, and that has remained elevated. But I think the problem is we're just looking at futures markets. We're not looking at the full extent of the sentiment towards gold. And if you look at OTC demand for so over the counter demand for gold, that's been strong. If you look at demand for gold in China, investment demand, that's also been strong. And so maybe when you add these factors together, we start to see a bit more of a rationale for why gold prices are this high. In addition to that, central bank demand for gold has been extremely strong. Since 2022, um, gold demand has been from central banks has been roughly double the levels we saw prior to 2022. In annual terms. So if you take the annual average in that decade prior to 2022, we're at double that level, and we've remained at very similar levels to 2022 in 2023 and 2024. And the story behind that is really that since the Russia-Ukraine war, um, central banks are a little bit spooked by um, the fact that G7 currencies can be somewhat weaponized. Assets in those currencies can be frozen. And central banks are very keen to move away from um, these kinds of currencies that can easily be um, either weaponized or debased, like the dollar, yen, euro. Um, in addition to that, there's increasing discussion in the past month or so about a so-called Mar-a-Lago Accord, and let me unpack that a little bit. Um, there's discussion in the market that the US, which is displeased with the fact that it's been funding defense for much of Europe and other countries, and wants to monetize on this. It wants to um, get Europe and other countries to pay their fair share. And one of the ways in which they can do that is to say, well, you hold a lot of our bonds. We're going to switch from coupon paying bonds to zero coupon bonds. So we're going to issue long term zero coupon bonds, and if you want to hold treasuries, that's what you're going to have to buy. If they have to swap out into these zero coupon bonds, well, you know, gold, which is always been that alternative to the bond market as in terms of defensive assets, is on a much more equal footing, because gold one of the things that held back gold before, it doesn't pay any coupons, it doesn't have any yield. But now, if gold is on an equal footing to this tremendous bond market, gold has got the upper hand. So gold is becoming that much more attractive as a result. And US does that to Europe. Think about other countries like China. If you think about China's FX reserves, on the central bank, it's largely in US treasuries, and it accelerates the Chinese central bank's desire to diversify. So gold could be getting an additional lift as a result of the changing status quo, and especially around geopolitical risks and currency risks. So we're especially positive on gold as a commodity this year, and we believe it has further legs to move higher, despite the fact that it has looked we've already seen a very strong rally. Um, so gold is definitely one of our top picks this year.
Nitesh, just speaking of tariffs and just general uncertainty, you mentioned how it's just impossible to predict what the nature of the tariff will be, who will be tariffed, how much, and so forth. I know people, in order to hedge uncertainty and policy uncertainty and all sorts of market uncertainty and so forth, they turn to gold as a safe haven. But is there uh, a risk that gold itself might be subjected to tariffs? And is that a factor that's playing out in gold markets as well?
Yeah, it's a great question. So, yes, we have seen a bit of turbulence in the gold market as a result of uncertainty about the status of gold if the US applies a universal tariff on all imports into the US. Um, if if gold, for example, was subject to tariffs, the price of gold in the US should be higher than the rest of the world by the value of the tariff. And if you look at COMEX gold, so the gold, the gold futures market, which trades on the CME, it had in January and the beginning part of February been trading at a higher level than the gold prices in on the over the counter markets, physical markets in London. So there was that spread that opened up. It has actually narrowed a bit now because one, I think traders are just a little bit more. Um, well, they may have a little bit more confidence that gold could get some potential carve out from these tariffs. But moreover, a lot of gold has moved from London and Zurich over to the US. And so the inventories that are held in COMEX vaults has actually increased. And that gives people a bit more confidence that should any futures contracts come to expiry for and go to delivery, that there's a lot of inventory out there, and then, that's helped bring that spread between the two markets out. And it's not just limited to gold. That story of increased price differentials between the futures market in New York and physical markets in Europe also applies to silver, platinum, and palladium. Um, so, but they've now narrowed out a bit, but it's an area to watch because we haven't heard any carve out for any of these precious metals. I know logic would dictate that there should be a carve out, but that hasn't happened yet. And let's face it, whether this is high on the agenda for the Trump administration in terms of all of the various things that they're trying to roll out at a rapid pace, who knows? And so, therefore, as an oversight, we could see precious metals become subject to increased tariffs.
So, speaking of anti-venoms, Nitesh, you just mentioned silver, platinum, palladium, and we know gold can lift the rest of the group as well, and we have indeed seen some of that in recent times. Which of those is your next anti-venom, and why?
So silver, for sure, and in many ways, we believe that silver could even outpace gold this year. Silver has a very strong correlation to gold. So if gold prices move up, we expect silver to move up as well. Um, that's our expectation. But so far, silver has lagged gold a little bit. So it's got some catching up to do. Um, but beyond its correlation and catching up with the gold market, silver is in a deficit, in a production deficit. So what we mean by that is when you include investment demand, its demand is higher than the amount of silver being produced each year. And therefore, we're eating up above ground inventory on silver each and every year. And we've been doing that for the last 3 years. And we're likely to move into the fourth year of a silver deficit. And what's driving some of that strong demand in silver is a large amount of industrial demand for silver. So about 50% of silver is being used in industrial applications. And one of the sources of silver demand that's rising rapidly is photovoltaics. So that's solar panels. And we talked about earlier on, China with its net zero ambitions and investing a lot in renewables. China is likely to be deploying a lot more silver, energy production this year. But also, a number of other countries are likely to increase their silver usage as they increase photovoltaics. US is one of them. US is continuing to try to get more energy independence, and solar is one of the ways in which all the data centers and um, you know, uh, you know, AI and cloud based technologies that need to have some sort of independence of the grid will be able to increase their energy production. Now, in addition to that, we know that the silver supply is relatively constrained because silver comes as a byproduct for the mining of other materials like base metals, particularly copper, nickel, and zinc. And the capital expenditure in the mining for each of those metals has been relatively constrained. So silver is definitely one of our top picks from the precious metals complex. Platinum and palladium may also get a lift as well. We are seeing with the changing geopolitical, mood, particularly with the change in the administration in the U.S., that uh, the life of internal combustion engine vehicles could be that a little bit longer. So we could see that a bit more promotion of these internal combustion engine vehicles, which use a lot of these platinum group metals as a catalyst metal to change some of the so-called nasty gases into safer gases, and therefore PGM platinum group metal demand may also rise as well in addition to their correlation with gold.
So another group you talk about, Nitesh, is of course base metals, something that's not immune to geopolitics, not immune to trade disruptions, and certainly not immune to tariffs. And also, you mentioned how China might be upping their game on the energy transition front. Certainly, the group that is impacted the most as a result of that is base metals. We have seen some tariff announcements on steel and aluminium. Uh, but how do you see what's happening in the industrial metals front? Which ones constitute anti venoms in your view?
Yeah, so I think top of the list is aluminium. Um, that's a metal that's actually production is dominated by China, but China today has a cap on its production. And last year China basically hit its cap by November, and this year it may hit its cap even earlier than that. Um, you know, Aluminium is a metal that's increasing in demand for light weighting. Um, Things like cars and other machinery, so they become less energy intensive to use on the downstream. So aluminium demand is increasing substantially while the supply is quite constrained from China. And in terms of investment in production of aluminium from elsewhere, is being really constrained. Now, US is actually, in addition, adding this tariff to aluminium, which in normal circumstances, not in normal circumstances, but if you were to think about what the incentive for that would be, is for US production to increase. But it's very hard to increase US production. US production has dwindled over the past few decades through as China has become more dominant, and there are very few U.S. smelting companies that are willing to invest in higher production, knowing that there are political cycles. Because if they invest in smelting activity today, they have to know that these tariffs need to be in place for decades, not just one political cycle, which lasts 4 years. So there's a lack of investment in metal smelting. So aluminium, which is very energy intense. To just add to that, and when you got tariffs being placed on imports of oil and gas from its neighbors, it becomes very difficult as well to invest a lot more in aluminium production. So aluminium, we believe, will be a very strong metal. um, we are also seeing copper may be subject to higher tariffs as well, but that may be going a little bit further down the road. The US is initiated a Section 232 investigation into copper. We saw some of these 232 investigations take place back in 2018 during Trump 1.0. It's a long drawn out process. It can take a year or so for the investigation to take place, and then when the tariffs come, maybe several months after that. So the headwinds to copper demand may come a little bit further down the road, but we know right now copper is in a is likely to go into a supply deficit because there's a lot of question marks about mine supply. So mining companies are constantly revising down their estimates for production, whereas demand remains quite robust. And in particular, Chinese demand, once again, feeding into that energy transition, particularly grid upgrades. Zinc was also in a supply deficit in 2024, and its deficit is likely to continue into 2025, maybe at a lower level than what we saw in 2024, but there's just simply not enough mine supply at the mine and smelting supply at the moment to meet demand. That will ease over time as more investment comes into place, but once again, with all this tariff noise in the background, the incentive to invest in more production, starts to be put into question, and therefore we could see some of these zinc deficits remain in place for longer.
Nitesh, I would love for you to clarify for us this idea of whether tariffs are good or bad for industrial metals, in the sense that when tariffs were introduced on aluminium, of course, if there's a tariff announced, it doesn't hurt. Let's say demand stays the same, then of course you've pushed the prices up, and as a result, prices would naturally move in the upward direction. But if demand is hurt significantly, then you might expect that there's a competing force, and depending on which force is stronger, prices would move accordingly. But theoretically, do you think it's just that competing dynamic, and you just don't know how it'll pan out, or can we boil it down to a simple rule that tariffs are good or bad for commodity prices?
No, Mobeen, I think you're right. It's hard to say decisively good or bad. But what we do know is that higher prices usually entail demand destruction unless there is some stimulus or some other activity, or just natural growth in economies that's is not negated, right? So if you see growth in demand in general, then central banks aren't mitigating that increase in demand with interest rate increases, then you could see maybe that the demand profile would increase. But other things being equal, you would normally think that a increase in price, an artificial increase in the price through tariffs, would entail some level of demand destruction, and therefore become something price negative further down the road. But also, we also have to think about the fact that there isn't just one universal price for these commodities. The country that implements these tariffs is likely to see the price of the materials at consumption level increase by the level of tariffs, but the international price for some of these commodities may become hurt, or it may, or stay the same. So therefore, what just putting into illustration right now, we are seeing the copper price in in New York. So COMEX CME copper prices trade at a higher level than the London Metal Exchange price for copper. Similar things we talked about for gold and silver and precious metals. Also, we're seeing similar sort of thing for aluminium. So where we can see comparative prices, we do see a slightly higher premium in the US, reflecting those higher tariffs. But I guess for what most investors are concerned about is where is the most liquid futures contract, or where is the most liquid physical market in the case of precious metals. And and that's what will probably reflect where we are thinking, in terms of the outlook, in terms of what gets hurt. But it's I just want to stress that point is that nothing stays still. So if the US puts a tariff in place, what are other countries doing? China, we believe, will be stimulating to mitigate some of the tariff headwinds, and therefore we could potentially see higher demand for a lot of the commodities as a result of that second order effect in terms of the reaction.
So, to conclude, Nitesh, I want to go back to something you alluded to earlier, European natural gas prices. And it's interesting because we saw, certainly to begin 2025, a sharp increase in European natural gas prices. And since then, we've seen a slight pullback. Now, it's easy to fall into the trap of thinking that maybe it was an acute winter problem and we've now gone past it. But of course, we're here to identify antivenoms for the year and beyond. So, do you think the situation with natural gas, particularly in Europe, is a chronic one rather than acute one? How do you see the market?
Yeah, so the initial rally we saw at the beginning of this year was driven by cold weather. But it's not just the cold weather, it's the cold weather in addition to the fact that the storage of natural gas in Europe is way below average, and way below the average since 2022. And 2022 is an important marker because that's when the Russia-Ukraine war started, and we became much more reliant on storage of natural gas rather than the pipeline flow from Russia. So, if things remain the same and we get more cold weather at any point during this year, and more importantly, towards the end of this year, when we enter a new winter season, then we could see natural gas prices rally hard again. But things are changing, and almost since we drafted the outlooks, and there is a bit of a time lag between drafting outlooks and publishing. Things have changed, right? So the US is trying to broker a peace deal with Russia and Ukraine, and the progress is somewhat patchy. One step forward, two steps back at times. But it should we get an end to the uh, Russia-Ukraine war, then there's a question mark about whether we go back to the previous normal of seeing more pipeline flows of natural gas into Europe. Now, this is really an unknown at the moment. Yes, the US is looking really hard to come to a solution to this war, but the question mark is Europe ready to close all its sanctions with Russia? And is Russia ready to open up the pipeline flow of natural gas into Europe? That remains a big question mark at the moment. Should it do so, then we think natural gas prices could could fall in Europe. But if sanctions remain in place and Russian pipeline flows don't resume, and remember, it was Ukraine, a lot of the pipeline flows of Russian natural gas was going through Ukraine and was reliant on Ukraine signing you know, um, a deal with Russia to allow those uh, gas gas flows to go through its pipelines. If Ukraine doesn't renew one of these things, and you know it didn't renew at the beginning of this year, then we could be sitting here with still very little gas in storage and no new pipeline flows. And therefore, natural gas prices in Europe could rally strongly. So, very dependent on some of the political outcomes that we will see unfold over the next few weeks.
Something I find interesting, Nitesh, is of course the antivenoms you've identified belong in different commodity sectors. So even though we're talking about various macro headwinds, some of the support that investors might find might come from different sectors. And of course, we haven't even talked about agricultural commodities today, and we've seen parts of that sector doing very well as well in terms of price movement for investors. But any closing thoughts on how you see that idea that support is coming, and you're identifying antivenoms across sectors, and anything else that we've missed?
Yeah, I mean, you know, yeah, the missing part is agriculture, and you know, it's hard to write an outlook for a whole year because agriculture is so subject to weather changes. But what we are seeing right now, you know, maybe there's something that's relevant for the next few months at least, is the fact that we are in this La Nina weather cycle, and that is causing stress in certain crops. Um, Coffee in particular is seeing stress in Brazil, and as a result, its yield is likely to be a lot lower than in previous years. And we are seeing a very strong rally in coffee prices, but not just coffee. We are seeing some stresses in cocoa and sugar as well. So a lot of the soft commodities grown in slightly more tropical regions and slightly more um, exposed to some of these weather extremes driven by La Nina are doing quite well. But it's an area to continue to watch because, once again, a resolution in the Russia-Ukraine war could be an area where we may see, you know, slightly more ease of wheat and corn exports, for example, in the you know in the sort of that sort of Baltic region, you know, and that is considered, you know, the breadbasket of the world. So there's lots of things to watch out in the agricultural markets, and that's a lot of subject to how some of these geopolitical risks also pan out alongside the weather as well. But there's always things to look out in the commodity markets. So you know, we'll be continuing to put out our podcasts every month, and I think that'll be the great opportunity to actually refresh on where we are with some of these risks unfolding or magnifying.
Excellent. Well, we've covered a lot of ground. We've certainly covered the outlook. And we, at this point, have to thank everyone for tuning in. We hope you've all enjoyed this episode of the Commodity Exchange. Before we close, I do need to state the following to clarify. The views and opinions expressed in this podcast are those of Wisdom Tree and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell any securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results. If you do want to hear more from us, please subscribe on whichever platform you're using and do take a moment to leave us a 5-star rating. You can follow us on LinkedIn or X, and of course follow Wisdom Tree on those platforms. And if you want to learn more about commodities, visit Wisdom Tree's website, where we have a wide range of research materials and insights. With that, we will see you all next time.